For now, I'd like to introduce our speaker this evening, is Bill Gramas. He is a highly respected Wall Street Journal software industry equity analyst. He was with Gruntel & Company and LH Friend & Company. He began his 19-year Wall Street career with Mellon Bank and learned the technology and software industries while with Hambrecht & Quist and also Donaldson, Lufkin, and Genrat. He has had appearances with CNN, NBC Nightly News with Tom Brokaw. He's been featured with Barron's, Investors, Business Daily, among others. He received his MBA in finance from George Washington University and his bachelor's from Marquette University. So please help me in welcoming Bill Gramas.
Thank you, Mary. Thank you, Oak Brook Library. Thank you all for attending tonight. How in the world did we get into this mess? How in the world did America get into this lingering bad economy that just won't go away? I don't know about you, but I want some answers. I'd like to know how this happened, why it happened. I'd like to know the root cause of this problem. I'd like a solution, and I'd like this fixed. Let's start peeling away the layers in our quest to find the root cause of this problem and find a solution. And let's start with everybody's favorite topic, unemployment. Does anybody believe the 8.2% unemployment rate that the government posts as unemployment? The Bureau of Labor Statistics is the actual keeper of all the employment and unemployment data. On the first Friday of every month, the Bureau of Labor Statistics releases the unemployment figures for the prior month. So this coming Friday, we'll have the statistics for the month of April. The last month of data that we actually have is from the month of March, which was reported the first Friday of the month of April. On table A15 on the Bureau of Labor Statistics website, there's actually 6 different unemployment levels. Unemployment level 1, unemployment 2, unemployment 3, 4, 5, 6. The one that gets reported in the newspaper, the one that all of us, you and I, read in the newspaper is unemployment level 3, and for the month of March 2012, that was 8.2%. As the unemployment level rises to unemployment level 6, the number of people unemployed increase, and unemployment level 6 was 14.5%. BLS unemployment statistics are based on surveys. Surveys are not accurate. Let me share with you my calculations of unemployment. The good news is that the BLS actually offers lots of data. And of particular interest to me is the actual number of people employed rather than a survey of people who are unemployed. The reason why I'm interested in the number of people who are actually employed is because these are hard, cold figures. The Bureau of Labor Statistics gets these from the IRS. These are not surveys. Why am I interested in the number of people employed? In the mid-1970s, the US government actually changed the unemployment calculations. So if we were interested in, say, comparing today's unemployment level in today's horrible economy with, say, that of the 1930s and 1940s Great Depression, we're not comparing apples and apples, we're comparing apples and oranges. So this is my effort to try and even everything out so we can get a better comparison of apples to apples. And the BLS website on table B1, BLS actually lists the number of employed people. We know from BLS website that there are 132 million Americans that are actually employed. We know that there's 110 million that are employed in the private sector and 22 million that are employed in the government sector. We also know from the US Census Bureau that we have a total population in the United States today of approximately 313.5 million Americans. And we also know from historical figures that of the total population, there should be 56.3% of the total population in the labor force. Well, 56.3% times 313 million is approximately 176 million. And we know from just a minute ago that there's 132 million that are actually employed. So 176 million minus 132 million means that there's 44 million Americans that are missing. 44 million Americans divided by 176 million that should be in the labor pool is 25% unemployment. This is bad. On table A1, the Bureau of Labor Statistics actually takes a stab at calculating a similar calculation to exactly what I just went through, which is my calculation. The Bureau of Labor Statistics takes a stab at the civilian labor force, which in the month of March they listed as 154.7 million Americans. Well, again, going back to 313 million total population in America, that's only 49.3% of Americans that are in the labor pool. And we also know from a few minutes ago that there's 132 million that are actually employed. So 154 million minus 132 million means that there's 22.7 million missing Americans. This is the Bureau of Labor Statistics calculations, trying similar to my calculations. So the 22.7 million out of 154 million, that's 14.7% of Americans that are unemployed. The BLS further says that 158.8 million Americans are not even in the labor force. These are pathetic numbers. In the year 2000, 49% of the total population was actually employed. In the year 2008, 46% of the total population was actually employed. Today, 2012, only 42% of the total population is actually employed. And that goes back to the 132 million divided by 313 million total population. This is horrible. But these are not the root causes, and we're after the root cause of this mess and a solution. So let's continue to peel away the layers and find the root cause. Why is this labor important? We want all of our fellow Americans employed, for those who want to be employed. Why? Let's go back to that 44 million that I calculate that are missing. And let's say that on average, that average person can make $50,000 per year of income. Of course, some people are going to be making $20,000, and there's some that are going to be making $2 million. But let's use a $50,000 average. 44 million times $50,000 a year of income is $2.2 trillion of lost income per year. This has been going on for 4 years. That's $8.8 trillion of lost income, of lost wages that can never be recovered. The US GDP today, this year, is approximately $15 trillion. The 8.8 trillion is approximately 60% of our total GDP. This is bad. And if we go along further, the government should be paying close attention to this, because the government gets approximately 30 to 35% tax revenue on a $50,000 average income. That's $600 to $700 billion per year of lost tax revenue that will never be recovered, because the 44 million Americans that are not working are not working. In the year 2000, there were 9,000 publicly traded companies in America. These were companies trading on the New York Stock Exchange, on the NASDAQ stock market, on the American Stock Exchange. Today, there are fewer than 5,000 companies publicly traded in America. That is a decline of more than 4,000 companies. That is a decline of 43%. This is a nightmare. Companies employ people. The average Fortune 500 company has 55,000 employees. Let's look at two that have recently gone out of business. Borders Bookstore had 11,000 employees. Blockbuster Video had 10,000 employees. Let's assume that these average 4,000 companies had 10,000 employees. That's 40 million jobs that have disappeared because the 4,000 companies have disappeared over the last 12 years. Well, if you remember a few minutes ago, I was suggesting that there's 44 million people that are missing from the labor pool, and you can see that why this has happened. 4,000 companies have disappeared. That would paint a very different picture of America today if we had those additional 4,000 companies still here, still employing the 40 million people projected. We would be near full capacity. We would be near full employment. Jobs generate people's incomes. If people have income, they can then buy a house, they can buy a car, they can buy some furniture, they can invest in a young up-and-coming company. If there's no jobs, people are not going to be buying a house, they're not going to be buying furniture, they're not going to be buying a new car, they're not going to invest in young up-and-coming companies that will in turn begin to employ additional people. Other reasons for these 4,000 companies that have disappeared. Sarbanes-Oxley, enacted in 2003, is a highly regulatory act on publicly traded companies, making it very costly to be a public company in America. Eliot Spitzer in 2002 virtually eliminated Wall Street stock research. Public companies need Wall Street stock research so the public will know what's going on with their companies. The Federal Trade Commission over the last 30 years has let the merger and acquisition activity run rampant. Companies have been acquiring other companies. When Company A acquires Company B, you can bet that Company B is going to be losing lots of employees. I applaud the FTC for recently blocking AT&T Cellular's attempt to acquire T-Mobile. We need more companies offering more products and more options for our consumers rather than fewer companies offering fewer options. And fourthly, companies are just going out of business or leaving America. And I point to Borders Bookstore and Blockbuster Video as two that just have gone out of business. I can tell you from personal experience that there are very few new up-and-coming companies to replace the 4,000 that have disappeared over the last 12 years. America needs tens of thousands of new young companies to come up to replace the 4,000 big ones that have just disappeared over the last 12 years. Why is this happening? Why aren't young companies up and coming? Large companies today are sitting on over $2 trillion of cash in the bank. They're not investing that in research and development. They're not developing new products. They're not providing revenue for young up-and-coming companies out of that $2 trillion plus cash hoard. Private citizens are sitting on an additional $2 trillion of cash in the bank. Think of this as today's modern version of stuffing money under the mattress from the Great Depression. This $2 trillion from large corporations and over $2 trillion in private citizens combined could be fueling young company growth, and young companies growing will provide new jobs for Americans. Both unemployment and loss of companies over the last 12 years is beyond ridiculous. But we're still looking for the root cause of this problem, and we're looking for a solution to fix this mess. In 1994, Bill Clinton signed the U.S.-China Free Trade Agreement. In my humble opinion, this is perhaps the biggest economic blunder in U.S. history. In my opinion, this is the root cause for our lingering bad economy today. In my opinion, our current bad economy is providing us with a very unique opportunity to fix this mess now. In 1994, the China-U.S. Free Trade Agreement allowed China to fix their currency against the U.S. dollar at 12 cents per dollar. Today, after lots of yelling and screaming, the Chinese currency has increased to a whopping 15.89 cents per dollar. Well, what does this mean in English? Let's take this simple chair here. It's got wood, it's got glue, it's got nails, it's got a cushion. This chair costs $100 to make anywhere in the world. Wood is wood. It doesn't matter if it's made in Portland, Oregon, North Carolina, New Zealand, Australia, France, or China. Wood is wood. This costs $100. You and I can go and buy this chair down the street at the furniture store for $105. If this chair is made in the United States for $100, the company that made it will make a $5 profit. Well, if this chair is made in France, when it's finished, the French company will then adjust it for its currency and will adjust the cost. Well, this chair made in France is going to cost $132 because France uses the euro, and the euro is $1.32 to the US dollar. So this chair is going to be $132. You and I are going to buy this chair down the street for $105. We're not going to see many chairs from France at that furniture store because the French company is going to be losing $26 per chair. If this chair is made in China, when it's finished, the finished good gets currency adjusted. This chair is now $15 because of the currency adjustment. This same chair can be sold down the street. We're going to be buying it for $105. The Chinese company will make $90 of profit. We Americans are subsidizing this chair at 85 cents per dollar. Instead of getting $5 profit, they're making a $90 profit. This has been going on since 1994, and it doesn't matter if this is a wooden chair, if it's a computer, if it's a cell phone, if it's an F-16 fighter plane. Everything is 15 cents on the dollar. China has generated a huge trade surplus since 1994. Today, China is sitting on over $1.2 trillion of U.S. Treasury securities. And China is sitting on an estimated greater than additional $4 trillion of other U.S. assets. This is all at the expense of the United States. Thank you. We're subsidizing them at 85 cents per dollar. This is keeping Ben Bernanke up at night. Why? Quantitative easing is not working. There's been 2 rounds of quantitative easing over the last 4 years. Well, what is quantitative easing? Let's take a quick history lesson on quantitative easing. In the Depression of 1907, this was pre-Federal Reserve Board. The Federal Reserve didn't come into existence until 1913. The U.S. government decided to get the economy going again to essentially pay back Treasury security holders their money early, so that the people would be able to go out, take their money and buy a house, a car, some furniture, maybe invest it into a young up-and-coming company. So let's apply that to today. Let's say that each one of us in this room has $100,000 of money in a Treasury security. And there's about 20 of us in the room, so that's $2 million. So what does quantitative easing mean? That means the U.S. government is going to pay us back early our Treasury security in hopes that we're going to take that money and go out and buy a house, a car, some furniture, perhaps invest into a young up-and-coming company. Why is Ben Bernanke up at night? Well, in 1907, the bulk of the U.S. Treasury securities were held by U.S. individual citizens. So this was a great plan in 1907. Today, in 2012, the overwhelming bulk of U.S. Treasury securities are owned by China and Japan. And China and Japan have no intention of taking their early money back and coming and buying a house, a car, some furniture, or investing in a young U.S. up-and-coming company. China and Japan are just going to take their newfound money and turn around and buy another Treasury security. So quantitative easing has been a miserable failure. China's currency fixing to the US dollar is a form of protectionism. China is the protectionist. We, the US, are the fools that have let this happen. Let's take a quick history lesson of money. Prior to 1971, the world was on the gold standard. Richard Nixon ended the gold standard in 1971. During the 1800s all the way to 1933, the price of gold was approximately $20.67 per ounce. In 1933, FDR raised the price of gold to $35 an ounce, and that $35 an ounce lingered essentially till 1971 when Nixon ended the gold standard. In my humble opinion, this fixed price of gold did not fluctuate. In my humble opinion, this fixed price of gold, just as today's fixed Chinese currency against the US dollar, caused the lingering Great Depression back in the 1930s and 1940s, just as it's causing today's lingering bad economy. Post-1971, when the world went off the gold standard, each country was supposed to have their currency freely fluctuating against other countries. That's the whole idea of having freely fluctuating currencies. We were warned by great economists as early as the 1940s that currencies, if they ever were freely trading, cannot be pegged against one another. In this case, the Chinese currency is fixed against the US dollar. So how are currencies supposed to work? Well, each country has natural resources, and other countries can buy those natural resources for their use. So let's take some simple examples. Let's say that one country produces lumber for this wooden chair here. And let's say that another country produces pineapples. Well, let's say that in 2005, 6, and 7, there's big demand for lumber. So the countries that have lumber as natural resources are going to have a high price of lumber relative to the countries that have pineapples. Pineapple countries are going to have lower currency value compared to the value of the currencies for the lumber producing countries. Well, let's say that at some point there's an increase in demand for pineapples, lesser demand for lumber for whatever reason. The pineapple country currency will rise, the lumber producing country currency will decline. Think of pistons in an engine. Currencies go up and down, they freely fluctuate against each other, and then there's a domino effect for other countries that are purchasers of lumber and pineapples and cotton and other raw materials. And all of these currencies are supposed to fluctuate against each other like pistons in an engine, they go up and down. Well, when you peg a currency against another country, in this case China against the US dollar, it doesn't matter what the dollar does. It doesn't matter if the dollar increases in value relative to the euro or the yen. It doesn't matter if it declines. The Chinese currency is still 15.89 cents per dollar. It's fixed. So the US dollar moves lockstep and the Chinese currency move lockstep with one another. And that affects the whole domino chain of other countries that have freely fluctuating currencies. It throws a wrench into the whole system. It throws a wrench into the pistons. The pistons are not working. They're broken. In my humble opinion, the Chinese currency is way out of whack. I believe the Chinese currency is worth $1.11, not 15.89 cents per dollar. So my solution is that this Chinese currency must be unpegged from the US dollar, and it must be allowed to eventually get on its own and fluctuate on its own. Because the currency is so far out of whack, this is not going to be a quick fix. I believe it's going to have to be a 5-year plan. So that means that over 5 years, the Chinese currency would have to increase 50% per year over 5 years. So let's put some numbers on that. That means it would go from 15 cents plus 50% would rise to 23 cents, plus 50% will bring it up to 34 cents. Another 50% increase, 51 cents. In the 4th year, it'll bring it up to 76 cents. In the 5th year, it'll bring it up to $1.14. If this is not done over a staged-in process over several years, this will throw the whole world into a horrible depression, which is what we want to avoid. So thus the 5-year solution. If China does not voluntarily participate in this, I believe the US will have to impose a fresh new currency on China and go through my 5-year plan to get that fresh new currency freely fluctuating at the end of 5 years, standing up on its own 2 feet. This could get ugly, but the wrench is in the system and it's breaking the whole world's currency systems. The pistons are not working, and it's wrecking the whole world's economies. This Chinese currency protection must end now. These are artificial benefits to China. They are not natural benefits based on natural resources of a country. I am for free trade. I am for freely floating currencies. I am for each country offering their natural resources for consumption from other countries. And I'm for citizens of the world happily earning income, enabling them to purchase other goods and services. These are key elements from the Adam Smith's 1776 book, The Wealth of Nations. I am also for Americans helping Americans. I am not for America subsidizing foreign protectionist countries like China that are hurting our American citizens' jobs and our pursuit of liberty and happiness. The opportune time is now for this repair for the world's sake. Thank you. I think what we're going to do is we have a microphone up here, so if you'd like to come up to the mic and ask a question, that would be great. Is that okay?
I don't hear too much about what you say on the news. How widely accepted is what you're saying? Are you alone, or is everyone agreeing with you? Because if they were agreeing with you, I don't see a lot of talk about it. Maybe I'm watching the wrong things.
The question was, how widely known is this? How generally accepted is it? And that's a great question. You are not seeing this on the news. I wrote a paper on this back in 2009. I had a very difficult time finding economists anywhere who even followed things like this. This is a presidential issue. This is a presidential order. This is not a congressional topic. As a matter of fact, Congress has voted twice, 2006 and again in 2008, they have voted for a 25% tariff on all Chinese imports. This has been passed twice. It's not being enforced. This is not a congressional issue. This is a presidential issue. We are now on the third president that has basically turned their backs on this. Obviously, you know the first two, Clinton, then Bush, now here we are on Obama. Do you see this in the news? No. Is this widely discussed? No. I don't think anybody wants to discuss this.
You mentioned creating a special currency. Could you go through the mechanics of that again first so we have a better understanding? Do we create the currency or does China create the currency? And then secondly, could you comment on the geopolitical aspect of how China would react if this was somehow forced upon them?
So the first question is the mechanics of a new currency, and then the second was about the geopolitical ramifications. So it's at the benefit of every country in the world to have all other countries having freely fluctuating currencies. And when there's one country that is fixed, and by the way, it's not just China. There's a handful of other countries as well that also have fixed currencies to the U.S. dollar. But in this case, we're picking on China. This is a well-known currency fix.
Are they little countries, or is this France, big countries?
Some are very big. But China obviously is the biggest. I mean, essentially you have the two largest economies in the world fixed on the US dollar. And this is throwing off the rest of the world's currency system. It's a domino effect. So the pain that we see in the Eurozone, this is no coincidence. This is, in my humble opinion, driven because currencies are out of whack. And it's a domino effect. The euro is also affected because they are priced off the dollar. Great Britain's British pound is also affected. It's priced off the dollar. Everything everything is a domino effect. So going through the mechanics, it's the world's benefit. I would find it hard to believe that everybody in the world except China would want this to happen. I would be shocked if everybody in the world did not want this to happen except for China. China does not want this to happen because, you know, they're going to have to go through the horrible pain of having their currency freely fluctuating on its own without being supported by the U.S. dollar, without the U.S. Subsidizing them essentially at 85 cents per dollar. So the mechanics, if that's why I suggested that the U.S. may have to impose a fresh new currency on China, because I would find it hard to believe that China is just going to roll over and play dead and say, oh, we're going to go along with this. Why am I picking a 5-year plan? The currency is so far out of whack. The world would be in a horrible depression if this was not in a 5-year or longer plan to get this. The ultimate goal is we want the Chinese currency to be able to stand up on its own 2 feet, not being supported on its own. And the bigger goal for all countries' currencies is we want all countries' currencies to be fluctuating on their own. Your second question about geopolitical, that's why I suggested this could get ugly. I've had friends of mine suggest that this could start a whole new war. I read an article recently that suggested China is winning an economics war. There's many kinds of wars. It doesn't have to be just with guns and bombs. We are watching a war without even knowing it. Why is this not publicized? It should be publicized. In my humble opinion, this is a war, and we're losing badly, and we're handing it to China.
Yeah, another question. Just coincidentally, I'm retired, so I'm taking a class at Elmer's College. And the class is in American foreign policy. And yesterday the topic was China. And the instructor talked about, the same sorts of things that you're talking about. His conclusion was somewhat different. He did mention the fixing of the rate and thought that was problematic, but he didn't expand upon it. The professor was not concerned that China owns a couple of $1 trillion of our debt, and it's going to get bigger. And I said, how long can it go on? And his answer was, it can go on forever. We just keep on borrowing more. And I'm shaking my head, and I don't understand that. But could you explain a little bit more about the fixed currency? I studied economics in college. I never understood it in college, and I still don't understand it. One of the elements you left out, one of the other things he said that was very significant relative to what you're talking about was that China wants to keep it fixed because if they free it up, there's going to be massive inflation in China, and the massive inflation could result in another revolution within China. Yep. So for that reason, they're going to keep it fixed, okay?
But that's not our problem.
Well, that's not our problem, but I mean, if they have a revolution, it could be interesting what would happen. It may be to our benefit if they had a revolution, I don't know. Could you explain a little bit about the fixed dollar relative to labor? You talked about the wood and the seat, but I think the big advantage of China is that their labor is so much less expensive. And how does the fixing of the dollar play into the labor? Let's assume the chair were 95.
Okay, you got a lot of questions here.
Just the one question.
Yeah, you want to hit the labor?
Yeah, just
so the question is labor, China labor, and there's a big myth. The topic is Chinese labor. And there's a big myth, in my opinion, that Chinese labor is cheap. Well, it's cheap because it's 15 cents on the dollar. I was sharing this exact calculation with a cousin of mine recently. If the average wage in the U.S. Minimum wage is $8 an hour. Okay, the average Chinese wage today is $1.69. When you readjust that for 15 cents on the dollar, it brings it up to $11.26. So that's greater than the $8 an hour minimum wage in America. Or adjusting it to Chinese currency, the Chinese labor is currently $1.69 an hour, but if you adjust it 15 cents, it brings it down to $1.26 for minimum wage at $8 an hour in the US. So those are the equivalents. So the reason why I'm telling you that is because Chinese labor is already more expensive than our minimum wage of $8 an hour. So cheap labor is a myth. It's labor, just like wood, is also 15 cents on the dollar. You had a bunch of other questions in there, and I thought they were great. Just rattle some off, and I'll repeat them.
Well, his concern that, not his concern, but his point, that if they let the yen float, that China would have massive inflation.
Yeah. So let's hit on that one. Floating the Chinese currency on its own. That's why I propose a 5-year plan. In my calculation, my humble calculation, I think the Chinese currency today is worth $1.11 to the US dollar, not 15 cents per dollar, 15.89 cents per dollar. That's a huge gap. It's not even close. And yes, you're right. If the Chinese currency were allowed to freely float today, and I mentioned this in my presentation, the world would be in a horrible depression overnight. So there's got to be a 5-year fix or maybe a 10-year fix. But the ultimate goal is that China is going to have to be able to stand up on its own 2 feet. On the inflation topic, China already is in huge inflation. China has built cities. I find this hilarious. They have built cities with high-rise after high-rise building, one after another. They're completely vacant. The people there are using them essentially as storage vaults, meaning instead of putting their cash in the bank or cash in the vault, they're buying an apartment. And nobody lives in these apartments. They're completely vacant. It's their version of a 401k. So inflation is already off the charts in China. And a lot of this is at the expense of us, of the US, because we are foolhardily letting the Chinese currency peg itself to the US dollar. And we have not had a president since before 1994 that stood up to these people. This is a presidential issue. It's not a congressional vote. And we've had 2 congressional votes, and 25% tariff on Chinese imports, it's useless. 25% is not even close to getting it to $1.11.
Yeah, you said that the ratio should be, I think, 111%.
$1 so in my estimate, the Chinese currency to the dollar should be $1.11 to the dollar.
What determines that? How do you arrive at a number?
Yeah, that's a great question. So how did I calculate that? Very simple, and it's surprisingly simple. I actually am looking at GDP, and our GDP is, is it 2%? Is it 2.2%? Is it 1.7%? You get the ballpark. It's in that ballpark. So U.S. GDP, roughly 1.7 to 2.2% range. Just last week, we had the first quarter GDP of 2.2%. And China's GDP is close to 10%. That's a 7-fold difference, 7 times difference.
You're talking about the rate of growth.
Yeah, GDP, gross domestic product. Yeah, gross, right, exactly. So I'm taking that 7-fold difference and I'm applying it to the currency So how am I getting $1.11? It's very simple. $1.11 times 15 cents brings it up to $1.11. You know, that would bring it up to parity, meaning the GDP in China would somehow decline, and the GDP in America would somehow rise. They would somehow meet, or it's possible that the GDP in the U.S. will just stay the same, and the GDP in China will fall. But the point is, you know, how do we get parity? How do we calculate? You know, how does one even take a stab at calculating what a currency is worth? There's my humble opinion. That's how I'm deriving $1.11. It's from a sevenfold. It's just 7 times 15 cents.
Real quick, you probably already talked about this, and a lot of this is going right over my head. But anyway, who set that system where it's 85 here and it's 15 here? How did that get passed through the government and all that? How did
So how in 1994? So how was that originally passed? This was a U.S.-China free trade agreement. This was in a free trade agreement that Bill Clinton signed in 1994. And one of these items in the free trade agreement was the U.S. allowed China to fix their currency against the U.S. dollar at 12 cents per dollar. And you know, this is a popular issue in free trade agreements that presidents sign with other countries, especially ones like America trying to help another country that's in bad shape. The president in America seems to think that, oh, you know, we'll help out this poor other country and we'll fix their currency against the U.S. dollar. And what they're doing is not helping them, they're subsidizing them. You know, if you really want to help another country, you want that country to be able to stand up on its own 2 feet. And the worst thing you can do is subsidize a country so much that it's way beyond its means, and it's going to have to fall to be able to stand up on its own 2 feet. That's the worst thing you want to do. And that's exactly what would happen in the China case.
So there's no expiration on this agreement?
No, it's, yeah. And China is operating business as usual, and they have absolutely no intention of letting this go. You know, and China, you know, China hopes to have this continue indefinitely.
You said it was presidential, it wasn't by Congress, so is that just by decree?
Yeah, this is an executive order.
Okay, so
Just like in
5-year deal,
Yeah.
at your increments that
Yeah,
you gave, the
yeah.
next president could just say, starting out year 1, we're going to your first number, whatever it was,
absolutely
30 cents.
right,
And, okay,
23 cents, then 34 cents. Yeah.
okay, so he does that unilaterally,
Mm-hmm.
and then we wait for the reaction from China.
Mm-hmm.
That gets into the question of what happens
Geopolitical.
geopolitical,
Yeah.
whether they end up in a revolution.
Yeah. Yeah. This could get very ugly. This is you know, this is biblical kind of chaos.
Where was the Congress when Bill Clinton did that? So
The question was, where was, are you?
Agreements do not require congressional approval?
yes, I was.
Some of them don't. You know, this is why I mentioned in 1933, FDR passed Executive Order number 6102, April 5th, 1933.
Take NAFTA. NAFTA had to be approved by Congress. How does NAFTA differ from what Bill Clinton did
I don't know if was NAFTA,
with Mexico?
okay, was NAFTA a congressional approval, or was it a rubber
I
stamp?
recall it being.
Yeah, I think
It was.
I think it was
Congressional approval.
Or was it just a rubber stamp, congressional rubber stamp?
I remember them arguing.
There's a lot of horse trading going
Yeah,
on with it.
right.
Yeah, this is,
Remember, 1994, China wasn't what it was today, and nobody was really paying attention to it except for a few people.
That's a good point.
And the balance of,
Yeah.
the discrepancy in the balance of trade didn't occur until.
right.
It's only, if you charted it, it's probably
Oh, yeah.
incidental year one.
Yeah, and it wasn't really until late 1990s when this really started taking effect. So the first 5-6 years was kind of a flat line, and then it started taking off, and then the ramp was big, hockey stick up.
If it gets ugly in China, I imagine it gets uglier in the United States. Because I'm paying $10 for a pair of Chinese shoes now. I'll be paying $60, $70, right?
I don't know if that's entirely accurate, but
Well,
yeah,
there'll be an increase in-
you'll see an increase.
in my
Yeah,
consumption
yeah,
dollar, yeah.
yeah. But the ultimate benefit, if China is not, and other pegged countries are not weaned off of being pegged, fixed, this is going to go on indefinitely. This will not end. If we somehow get out of this horrible economy, and we can have another presentation on just how bad this economy is. It's not just GDP that determines on how good the economy is. There's actually 5 elements in how good the economy is doing. So income, employment, production, consumption, and GDP. And guess what? They're all in bad shape. So if this is not addressed and the U.S. does get better, this is still lingering over our heads. It's got to be fixed.
5 again?
Income, employment, production, consumption, and GDP. So just a quick tour. Income since the year 2000 is way down. Employment since the year 2000. I mentioned that in my speech. In the year 2000, there was 138, closer to 140 million total Americans employed in America. Today, there's only 132 million Americans employed in America. In the year 2000, there was 280 million total population. Today, there's 313 million total population. So these are the key elements for why I'm interested in benchmarking unemployment versus how many people are employed and what's the total population, rather than surveys. But going back to income is way down, employment is way down from 2000. Production has not recovered. Consumption, I don't need to tell you about consumption. People have cut back on everything. GDP is barely above zero. This past quarter was 2.2%. These are the 5 elements. These are not my. These are from the National Bureau of Economic Research. These are the guys that actually call a recession and depression, and these are in their writings. These are clearly the items they discover to see how the economy's doing.
And the 2.2%, if it's 2.2, is nominal, and actually probably negative when you account for population growth, because you went from 280 million to 313 million. It's like having inflation.
Right.
Zero interest rate.
Right. So finishing up your calculation, it's very simple. The 2.2 minus CPI. So CPI is about 2.7%. So 2.2 minus 2.7 is minus 0.5. So there you go. There you go. That's the exact calculation.
Lost money standing still.
You got it. You got it.
Well, isn't the real unemployment rate like between 15 and 20%? If you take
Yeah.
into context.
Yeah, so the question was, what's the real unemployment rate? And actually on table A15 on the BLS website, they actually list the 6 official unemployment rates. You weren't here at the beginning. I actually covered this. And the reason there's 6 different unemployment rates is exactly what you're talking about. As it broadens out in the month of March, the broadest unemployment 6 was 14.5%. And then I went through my calculations, and then I went through the BLS calculations. And the reason why I'm using number of people employed rather than people unemployed is because the unemployment is based on surveys. Surveys are not accurate. So the reason why I'm looking at the number of people employed is because those are hard, cold figures. They're not surveys. They're real numbers, real, solid. Sorry.
Okay,
Yeah.
that chair costs $100
Yeah.
here in America
Yeah.
to make.
Yeah.
Okay, and it hits the American shore in some big crate, probably in Long Beach or something over there.
Yeah.
And it costs $15 for that chair
From China, right?
from China.
Right.
Okay? So why don't we, if we're so worried about this Chinese thing with, with the dollar and all that, then they're going to get all mad about it. We say when that chair hits American shore for $15, we quadruple or 5 times that chair. Let's just use quadruple for a second and say that chair now costs $60 and there's $45 somewhere. And now we have that $45, and probably not too many more people are going to buy that chair because we can probably make it for, closer to the same amount. So maybe they'll buy our chair, and that $45 that we saved, we can use it somewhere in our economy. Now, why don't we play hardball since they're playing hardball and not take this product in from these other countries, because we're obviously not shipping out as much to them, and if they tax us for what's going to them, fine and dandy. We just don't want these Chinese products hitting our shore at 15 cents on the dollar.
Right. Yeah. So the question was a tariff question, and what would I do if I was the governor of California? So that's exactly right, Dave. In 2006 and again in 2008, the Congress passed 25% tariff on all Chinese imports. And yes, you're right, when they hit Long Beach and San Pedro ports, the Congress 25% tariffs, well, guess what? They're not being enforced. They're just not being enforced. If I was the governor of California, I would have a California tariff and I would charge them $100 instead of $15, absolutely. And I would take that and pocket it for the state of California, for revenue for the state of California. And these are all, they're Long Beach, San Pedro, they're up to Oakland. And if I was in the state of Washington, in Seattle, they have a big port, I'd do the same thing in the state of Washington. You're absolutely right. And if I was the governor of California, I'd be playing hardball, you bet.
The light bulb went on when the gentleman in the green shirt here said he was going to have to pay $60 for his shoes instead of $10, or I'm not sure. The presidents aren't paying attention because everybody would pay more for everything, whether it's the shoes, the TVs, the cars, what have you. All our prices would go up. Well, the chair made by the guy in Portland sounds great from the employment situation in Portland, but then everyone else in the country got to buy the $100 chair instead of buying the $15 chair. And the politicians, I think, are just panicked at the idea if we couldn't get, quote, the cheap goods from China anymore.
Well, no, that's not exactly right. The chair that you and I buy down the street is $105. That's what we pay. The cost to make that chair in China is $15. If it's made in the US, it's $100. So if it's made in a company in Portland, Oregon, they're going to make a $5 profit. $105 that we pay, that we buy it for, $100 that it costs them to make, $5 profit. If the chair is made in China, $15 currency adjustment, the calculation is 105 minus 15, that's a $90 profit. You and I are still buying the chair at the store for $105. It's the cost part that gets adjusted. Their cost to make it declines to $15, not $100. So instead of the manufacturer...
But we're not paying 105 for the chair. I mean, if you look at
We are. When we go to the furniture store, this chair costs $105. This is my example. It costs $105. I mean, I bought one recently and it cost me $105, and I kind of calculated, gee, what's this worth? And
we're buying all this stuff from China because it's cheaper.
no, we're buying it from China because the company that makes it in Portland could make it in Portland and make $5, or that company in Portland can move their company to China and now make $90 profit.
But when the guy...
So remember the 4,000 companies that have disappeared? Guess what?
But when the company in Idaho decides he's going to sell it for $95, it's a fact over the last 20, 30 years.
Well, he would be losing...
For electronics, cars, everything else, because they're coming out of China.
Right. That's because the cost part is declining. It's going down, it's 15 cents per dollar. We have to look at the cost part. Everything gets adjusted to 15 cents per dollar. It doesn't matter what it is. Intel is a great example. Intel has a $9 billion factory.
Let me say it another way. If we follow your program, 5 years down the road, China's now at $1.11.
Right.
We're not going to be buying from China anymore.
Exactly.
We're going to be buying for 20 different other countries.
Absolutely.
Okay?
Yeah. And those countries will have freely fluctuating currencies. The goal is to have freely fluctuating currencies. And the currencies are freely fluctuating based on their natural resources. So if a country has no natural resources, their currency is not going to be worth much.
And everything's going to cost more. I still can't get past that.
The manufacturing, cost, I guess we're using the word cost. Cost means manufacturer's cost. Retail means what you and I pay for it. So you and I pay $105 for a chair at the furniture store. When we go over to Macy's or Bloomingdale's, we pay $105 for the chair. Then the profit margin comes in to the manufacturer. Well, how much did it cost the manufacturer to make the chair? Well, this chair costs $100 to make anywhere. But when it's made in a foreign country, it's currency adjusted when it's finished. So with China, in China's case, it now becomes a $15 chair. It's the manufacturer. We're now on the manufacturer side. We're not on the retail side. We're on the manufacturer side. And the goal for the manufacturer, of course, is to have the biggest profit margin he can get.
Then how do you explain all the decrease in electronic pricing over the last 15 years? You used to buy a 27-inch TV for $2,000. Now you can buy a 90-inch TV for $2,000.
Electronics has a different kind of economics. It's called price elasticity. And that means the greater the volume, the lower the price. So that means if you're, let me do some quick math here. If you're selling $100,000 worth of items worth $1, you're going to sell 100,000 of them. If you can sell 200,000 at 50 cents, that's price elasticity. The price has declined, the volume has increased. So you've doubled the volume, you've cut in half the price. That's what price elasticity means. That can happen in electronics because the component parts get smaller and smaller and cheaper because the cost to make them decline. you know, as a semiconductor chip goes from x86 to you know, today's you know, quad 4 duo, you know, the circuitry is much smaller and much cheaper. Not currency adjusted, it's just cheaper. Instead of being $100, it's now down to $20. You know, if you go to, if you buy a computer, you can add RAM. I just bought a recent new laptop. I was able to double my RAM for an extra, I think it was $18 for an additional 4 gigs of RAM. You know, 2 years ago, you couldn't get 4 gigs of RAM for $200. You know, it's just cheaper. But finishing up your question, the real issue is on the cost side, the manufacturer side. I don't mean costs that you and I pay, all of us pay. I mean the manufacturer's cost, 15 cents per dollar, and the you know, the currency part. The manufacturer would much rather make $90 of profit, 105 that you and I pay minus $15, $90 profit, rather than making it in Portland and only making $5, 105 minus 100. You and I are still paying $105 at the store.
I think the concern for both of the parties about the gym shoes and about the chair is about what happens to us as consumers. How much more are we paying? I think the whole argument can be made about the fact that, yes, we might pay more, but not necessarily so. But in fact, paying more for products means that we actually are supporting a standard of living in our own country and not subsidizing the Chinese, which is in fact what we've done. In 1994, it may have seemed like a worthwhile thing to try to bring China into the world economy and all those good things that all the liberals, and I'm one of them, think is a great thing. However, it's backfired because we've never structured a change in the
exit plan.
Pay. Right, we never put a time slot on it. So the cost that we're going to pay for that share is the guy, somebody else is making that profit. It's no longer an American company, or if it is an American company, it's an American company that is based out of China, working out of China, but maybe headquartered in Seattle. But there has already been a number of companies who've moved on from China to other places, Thailand, Vietnam, et cetera, because the cost of production in China, due to the inflation, has already affected their business, and they see margins, and they're always chasing margins. They see better margins someplace else. So they're going to move on to a better quality workforce, newer facilities, the government may buy them a factory, any number of these things. So as consumers, we're still paying the same bill.
That's right.
The question is, are we in fact subsidizing, and we have been, subsidizing an entity which is going to gobble us up if we let them continue to do it?
Yeah, exactly.
We're letting them gobble us up because somebody doesn't want to step into the breach and say enough of this.
Yeah. And further, there was recently an article in the New York Times which was fascinating. It was talking about the whole ecosystem that's developed in China. So the article was focused on the Apple iPhone. And if you can imagine the Apple iPhone facility plant right in the center, and right around it, they have a glass manufacturer, a plastic manufacturer, a circuit board manufacturer, an antenna manufacturer, a battery manufacturer. The whole ecosystem is right around the Apple phone. And if, we need 1 million new glass sheets right away, it's right across the street. And we'll wake up people at 2 in the morning and we'll get those glass sheets over to you pronto. So a whole ecosystem has developed, and I find it fascinating, and you're kind of touching on this, at some point that ecosystem is going to break down. And I mentioned this earlier, the hourly wage in China is now $1.69. And if you adjust that to the US dollar, $8 an hour minimum wage, it's $1.26. So the Chinese wage is already greater than, cost adjusted, greater than our minimum wage. But you have this huge ecosystem that's already built, and we're talking billions of dollars of plants that may have to be abandoned. And we've seen that in the last 12 years here in America. Sure. The capacity utilization for factories and facilities, there's whole buildings that are multiple football fields in size that have been completely demolished because they were not being used. So the other topic that you were just brushing on without knowing is called expatriated funds. So this has been a hot issue in the last couple years. There's trillions of dollars from US companies that's stranded in foreign countries, just sitting there because they don't want to pay the tax to bring the money back into America to use to build another plant in America. So I go back to Intel. Intel has a $9 billion facility in China. Well, just recently, I believe they're building one in Arizona and one in Utah, you know, which kind of suggests to me they see where things are going. So I don't know if you intended on that one, but expatriated funds, I think, will be a critical issue as well. Yeah.
Are tariffs the only way that we can influence the Chinese into what we want and what we're looking for? Going through tariffs? Is that the only way to do it?
No, the question was on tariffs. Is that the only way to do it? And no, tariffs have not worked. There's two that have been passed, 2006, 2008, both from Congress. They're not being enforced. No, they don't work. This goes to the presidential office. This is an executive order. In my humble opinion, these free rides must end. So, you know, we're going to have to find a president. We've gone through 3 of them now that have done nothing. So we're going to have to find a president to make this work.
What have we done to convince the Chinese that they had better act or do something?
I don't think we've done anything. And I'm not sure that we have to do anything. The issue is, are we going to let America continue to decline and continue to fall apart, and at the expense of letting China keep their currency at 15 cents per dollar? And at some point, someone's going to have to wake up and say, this has got to be fixed. And that's exactly why I gave this presentation. You know, this is, if this continues, even if we get out of this horrible economic problem today, this bad economy today, and I'm hesitant to call it a recession or depression, let's just call it a bad economy. If we get out of this and this Chinese currency is not fixed and other free trading currencies that are pegged to the US dollar are not fixed, this problem will forever linger over our heads. And it could pop up at any time.
Who are the other countries besides China?
There's several. India, Russia, Brazil.
The big ones.
Yeah, some are pretty big.
Pretty big.
Yeah.
Covered half the world population.
Yeah, and it's fascinating if you read economic historians, great economists, Milton Friedman. In one of his books, he actually points to Great Britain's demise in the 1800s. One of the big reasons from an economic standpoint was Great Britain was allowing other countries to piggyback on their currency, just as America is doing today. Great Britain is still Great Britain, but it's not, Great Britain is a shambles of what it once was. And you know, we should take a lesson from that. You know, unless we want America to fall by the wayside, you know, something's got to be done. Sorry.
You know, I watch the mainstream news every night, and according to that, unemployment's down, housing sales are up, retail sales are up, so I don't see the problem, right? No, joking, but at the beginning, you spoke of the 6 levels of unemployment, and you mentioned that the government only uses stage 3 or level 3. I guess I missed that. What are the 6 different levels? What do they describe? What do they?
Sure. So the question is on the Bureau of Labor Statistics has 6 different unemployment levels. And again, these are all based on surveys. So I don't know if you've ever been unemployed, but in order to collect your unemployment, you have to pick up the phone and press some buttons and say you're willing to work and you're unemployed and you're still in trouble, and they'll send you your unemployment check. These are surveys. At some point, those people that are on the unemployment will end. State of California is looking at millions of people in this year, 2012, that will fall off the unemployment rolls. So, I think what you're kind of getting at is, what could unemployment do, in the next 6 months, 9 months? It's very possible, and I would not be surprised if unemployment was down to 6%. And the reason is that people have fallen off of the surveys. They're no longer on the surveys. So that's why I don't put much credence in the unemployment levels, because they're all based on surveys. They're not based on hard, cold number of people employed.
So the 6 levels are all basically different surveys or different?
Well, they're based on the same survey, and the unemployment 3, I'll have to look this up to give you the exact answer, but I believe it's for people that are currently filing for unemployment. And as you gradually go up to unemployment level 6, they try to estimate, well, there's 2 million people that used to be on level 3, and now we're going to somehow make a guesstimate so they're on level 4, and then somehow make a further guesstimate that there's another batch that used to be on level 3. Well, now we're going to make a guesstimate on level 5. So the way they term it is people that have given up. So when you get up to level 6, they try to take a stab at how many people have actually given up looking for work. So that's why I go back to, I'm interested in how many people are actually working, and I'm kind of working backwards. How many people should be in the labor pool, because there's lots of people that you could go back to the year 2000, in my humble opinion, was when we were at the last peak. And lots of people from the year 2000 are still unemployed today that never became reemployed even at the 2008 peak. So, those people from the year 2000, what are they? Are they retired? Are they, they're long off the surveys.
They're just not counted.
They're not counted.
Can I just ask a quick one on this?
Yeah.
You're talking about, when you're talking about people employed, are you talking about full-time people, permanent? You're not including the part-timers?
No. Employed means employed.
Permanent employed?
No. This is employed.
Full-time, in other words?
No. Employed. Anybody.
Okay.
This is from IRS. This is from payroll. You're yeah. FICA. Think of FICA. Yeah. You could be part-time and still pay FICA, right?
Now, one last question.
Yeah.
You had mentioned about starting another currency here as an option with China. How would that all work?
Yeah. Well, the goal is, the ultimate goal is we want all currencies that are pegged to the dollar, we have to wean them off the dollar. They cannot be subsidized. America is no longer in a position to subsidize these currencies. We are no longer in a position to subsidize the rest of the world. as goodness of our heart as we'd like to have, we just are not in a position to do it. So what we have to do is get these countries that have currencies pegged to the dollar or we're subsidizing, we have to get them to stand up on their own 2 feet. And some of these currencies are so far out of whack that it's going to take a long time, it could be a 5-year plan, to get them to be able to stand up on their own 2 feet. But the ultimate goal is we want them to be able to stand up on their own, good, bad, or indifferent, because we can't support them anymore.
Given the current situation in this country with the economics, if nothing changes, how long do you think we can go like this?
Wow, that's a great question. How long can America continue on our current course? Boy, Charlie, I don't have the answer to that one. I would suspect we could go on indefinitely, but what would happen to America? I read a Russian economist, I think it was 3 or 4 years ago, was predicting that America would end up being broken apart. The southern part would go to Mexico, the northern part would go to Canada, California, Washington, Oregon would go to China, the eastern part would go to Europe, would be broken apart. Is this some Looney Tune Russian economist? Or does he have something that we should really pay attention to? And yeah, I'd like to hope that he's a Looney Tune Russian economist, but I also think that, that's a shot across the bow. We have to pay attention to that because, you ask a great question. How long can we go on? I don't have an answer, but, things are not pretty.
I'm a big hockey fan. I hope we go to Canada.
It may go on indefinitely, but with an ever-increasing declining standard of living.
Right.
And, given our ages, excuse me, everyone in the room, we may be okay in our time, but our kids or our grandkids just won't have anything near what we had. You could, in your own, we're all from Depression era parents or something, you could go back to the Dust Bowl, Depression time, and that's what the grandchildren will have. They'll be selling the apples on the street.
The real issue here is innovation. And economies grow from innovation. And I think part of the 1994 free trade agreement from Bill Clinton was, we Americans no longer should be making semiconductor parts or making wooden chairs. That's not good enough for us. We should have all our kids go to college, and we should all be brain people. That's great, but unless we have innovation, we're not going to have a need for brain people. And how do we get innovation? Innovation comes from product development, from research and development. I mentioned in my presentation there's probably close to $5 trillion of American money from large companies and private individuals that's sitting in the bank account collecting 0.01% interest. They're fearful. Innovation is not occurring. You need new, thriving young companies to come up to replace the 4,000 that have disappeared. And some of these rightfully so. Borders Bookstore. Well, do you really need Borders Bookstore? Yeah, I'd like to say, yeah, we need it, but you can buy a book online. But in the meantime, we need further innovation. And I know from personal experience, young companies that have great innovation are not getting the backing they need to grow. they're not even getting the backing to get to first base.
These other countries, India, Russia, did Clinton sign those, or are those from other presidents previous to that?
Previous.
So this has been
And some,
going on for
oh yeah.
30, 50 years?
Oh, yeah. Well, you can go back to the 1800s. Yeah. Yeah, 1800s. I mean, Great Britain was doing this.
It was convenient at the time.
Yeah.
How can, excuse me, how can we, as people sitting around here, do something to light the firecracker under somebody's presidential plot to get things moving in the right direction? I mean, I can write a letter, but what the hell is that gonna do? You know?
Corruption.
Yeah, this is, I mentioned earlier, this is a presidential issue. This is not a congressional issue. This is an executive order topic. I believe that our current president and some staff are actually in China as we speak. Who knows what's going on there? But this has been going on now for 3 presidents. And I believe a couple of the candidates have actually mentioned this. Romney, and when Trump was running, he was discussing this. This is something that has to be addressed. And in my humble opinion, unless this is fixed, we're in for more bad times. Sorry, Mike?
Go ahead, Charlie. Real quick, you just mentioned about education.
Yeah.
There's, I'm all for everyone, every child being able to get a great education and a chance and an opportunity to go to college. But there, in this country right now, there is such a gap. You talk about manufacturing and skilled labor. There is such a gap in a skilled labor force in this country. Okay, I work every day in schools. And for years now, schools have been removing shop.
Yeah.
Okay, there's no shop class anymore. There's no automotive class. There's no wood class. Okay, it's all computer. Okay? Science, it's all to higher education, which again I'm not against, but it's creating such a gap in this country. Not everybody can be doctors and lawyers, and I see that as a big hurdle coming to this country. It's already here, actually.
Yeah, I
That's all I
agree.
wanted to say.
No, you're
I
absolutely
agree
right.
with you
The
100%.
possibility to produce what we want.
Yes. Sorry. Go ahead.
Way back when we talked a while ago when China was sponsoring the Olympics, all the prices in America were going sky high: steel, wood, oil, gas, you name it. We talked a lot about this, and you said China was hogging all this stuff for the Olympics. They were building these beautiful buildings and Ephesus and everything else to make their country #1 for the Olympics. They succeeded. They did very well. The pollution out in China is so great that they had to, for the months before the Olympics were coming there, had to close down all the traffic that was going into this city for China because of the air pollution that was surrounding the city, because the athletes were going to have trouble running, swimming, doing track and field, whatever they had to, because the pollution out there is unbelievable. I work for a company that we have many plants in China that we import products here for our customers here in America. We visit them maybe 2-3 times a year for the quality of the products that are going into them. The Sunbeams, the Hamilton Beach, as you all know these companies, Procter Silex, they all built their coffee makers, irons, hair dryers, all are done in China. The facilities that these are built into, they have the people live in these facilities. They are like 1-bedroom apartments that are just like slum holes that you see on the south side of Chicago and elsewhere in America. These, like Bill said, they'll call these people up at 2 o'clock in the morning to go out and manufacture something for their plant. They do not care about life out there. They have 6 billion people. They do not care on how they work, how they live. Bill said that apartments are empty in the big major cities. Yes, they are. These people are continually going out to the mountains to go get work, as these companies are moving out to the mountains because they're being taxed by the Chinese government. they're being harassed by the Chinese government. They don't like that, so they keep moving away, moving away, moving away. Well, they take the people with them. These people are, as we pointed out, if we continue to do this in America, that's how our manufacturing plants are going to look like if we continue to let this happen. We are going to be living in these plants, just like they do in Russia, just like they do in China, just like they do in Brazil. All the textile mills in America are moved to Brazil now. Brazil, you can go and look them up on the internet and see these football-sized fields of textile mills and textile plants out there. I know from firsthand, our linen comes from Brazil. We used to get them from Pakistan, but they had this tsunami. They upped their prices so much. The cotton goods got destroyed over there. Brazil has just come about, and with their labor force and ingenuity, have built these beautiful, beautiful plants, all subsidized by American companies, mind you, that have brought these linens back to America to sell. Yes, Europe does do their fraction of linens in Italy and in France and in other companies in Germany, which are very, very high-class manufacturing linens, but only sold. I work in the hotel business, so they're sold to the five-star hotels, the luxury hotels, European hotels where they have the little boutiques that you rely on all this high-class fixtures out there. China, on the other hand, has not come to be living green. They still have the plants that are not living green. They still do not protect their employees. They make nothing, but yet every year you see a price increase in the price of the goods that are coming over to America. Why do they do that? They claim it's the metal. They claim it's the oil. They claim it's the plastic. They claim it's this. They claim it's that. This year there's going to be 2 tariffs put on cartons and containers that are shipped to America. There's one that was put in March. There's another one going to be put in September. This is the tariffs that are being put on these containers that are goods that are being brought over to America. What's going to happen with those? The price is going to go up. Just for instance, there's a refrigerator that we used to purchase in China that our cost was $215. Just so happens right now we cannot get that refrigerator because it's going through some new certification rules implemented by China and America. We can get that same refrigerator now that is made in America, in North Carolina, for $275, our cost. So yes, the gentleman there was correct. You are correct. If we allow this to happen, our price of goods are going to go up. But we're going to get the quality coming back from America. Less shipment costs, less the freight costs. But buying by Living Green rules now in America, that every plant has to be LEED certified. It'll be a cleaner America, but as Charlie said, there's not these skilled people to make these products anymore.
Yeah.
They have gone away.
Yeah.
Because our schools are not teaching this. We are not teaching this because the American companies have said, we'll go overseas and train these people for nothing. So we need to train our people here. We need to get on the bandwagon. We need to bring things back to America. It'll take 10 years, but it can be done.
Right.
And that's how you're going to shut down China.
Yeah. Well,
Do you have any reading material? Where does one go to learn more?
I can send you, I wrote a paper on this in 2009. I can send you that.
Website?
No, I don't. We may make one.
No books, articles, anything you can?
I would highly recommend some of the Milton Friedman books, Free to Choose, Tyranny. I have a bunch of them on my bookshelf. Those are my favorite. There's another book that's out of print called Money by Ritter. I thought that was a great book.
Okay, Bill, at this time, I'm afraid I have to interrupt and have everything brought to a close because the library is going to be closing and we have to shut down. But please, thank you so much for your presentation.
Thank you.